Hello and welcome. You're tuned into CNBC TV 18 Prime. Let's get cracking on a brand new edition of The Big C from the CNBC TV 18 Prime Ionic Wealth Studio. I'm Manisha Gupta, back with your daily dose of commodities, crypto and currencies. A quick look at the Asian markets first, and the Wall Street, of course, on account of Thanksgiving mixed trade across indices. We have seen flattish moves with a negative bias. Back home, moves largely muted after scaling those lifetime highs just about yesterday. The crude oil prices, in the meanwhile, are headed for their fourth monthly decline. All eyes now are on the OPEC Plus meeting scheduled for this Sunday, where the expectation is that you could be looking at no increase for the first quarter of 2026, but it really is going to be about the long-term quota for all the OPEC members that can be on radar. Meanwhile, there's also brewing downside on the US dollar index as chances of a rate cut from the US Fed Reserve continue to mount higher. In a recent review of the U.S. economy, the Federal Reserve's Beige Book points towards a cooling labor market and a softer spending therein. Let's discuss gold and silver prices first with Kishore Narne, Director Head Commodities at Motilal Oswal. And we also have Peter McQuire, he's CEO at trading.com. Gentlemen, hi, thank you so much for joining in. And it really has been about silver, which has not just outperformed, but has been quite volatile, has amassed newer buyers as well, as we've seen nearly 87% of returns in this year itself. Peter, what's your sense on from where we stand right now? We're just few cents away from that all-time high yet again. How would you look at this year ending, and what's your sense for the next year now?
Well, lovely to join you, Manisha, and greetings from Sydney. I tell you what, I looked at the screen, it was up a buck. And the way it's going, it's probably got the capacity to take 60 out by end of December. I just think the overall momentum, and that might be a little bit bullish, but it seems to be on a tear at the moment. And it's even leaving gold in its tracks. I mean, that's just extraordinary, 87% up for the year. And we've still got a month to go. So, yeah, I'm going out there and I'm thinking it's going to be high 50s and it might crack 60. If it gets to 58, 59, Manisha, I'll be very, very happy. So that's the overall theme. And I think 26 is going to be a very exciting year for it as well.
Peter, what is the range that you're looking at for 2026 then? Because if you think 60 can be done in the next couple of months itself, how are you looking at the overall next year? Is it going to be range bound with higher highs then?
Well, let's get through 65. And if we get through that, Manisha, and it's got momentum and it's got, I think, market sentiment's very, very bullish regarding silver. If that is this continued story leading into the first half, then, you know, let's just review it. Probably $70 it's capable of hitting, but it's very, very hard to imagine if you were this time last year and you're going to tell me that it's going to be up nearly 90% by the end of November. I would have thought, well, that's extremely bullish, but it's delivered, Manisha. That's the issue. It has delivered. So when it delivers, that gives you the capacity to say, yes, it's got more upside than downside. And I just think that, yeah, Fed rate cut in December, probably a big chance, and that's going to add even more momentum to it.
Oh, well, absolutely. The latest trigger clearly has been the U.S. Fed probability on that rate cut that could happen in the month of December. Kishore, what's your sense? Because when we started the year 2025, you were absolutely bullish, and you, after the first targets for Motilal Oswal were done, you came out with the second one that's being done as well. And now the markets are talking about 60 and 70 for next year and 2 lakh rupees perhaps for the Indian markets as well. We are inches away from those all-time highs in silver yet again. What is it that the in-house report now suggests, and how are you looking at the prices moving for the near term and slightly longer term as well?
You've seen our report, the last one, where we mentioned around $90 in the next 18 months or so. I think that will take you close to around 50-60% from here. For the next year, it's around 72 was our base case scenario by the end of 26. And again, silver always surprises you with the speed. You might think about 18 months, and most of the times it achieves those numbers in 6 months. So that's the speed which generally silver is always on the surprise. I think the underlying tone is silver will outperform gold in 26, and the upside base case scenario remains at around 72. Average price for the year could be around 62. That's the average for 26.
Kishore, where do you see newer buyers coming in from? I mean, we do understand that US buys a lot, China does, Russia has bought a bit, and then India absolutely went on and bought huge quantities, especially from the investment part of it. I'll come to the industrial part slightly later, but the investment demand in India, especially for ETFs, but that physical buying, which led at one point in time to a 40,000 rupees of a premium per kg. I mean, that was huge. That was new buyers coming into the market as well. Do you see sustainability of newer buyers coming in as silver continues to rise?
Manisha, I think when you look at commodity prices, most of the times the last buyer, what every that additional ton of demand which is coming, that the marginal demand, what we call, is what actually drives the price, not the base demand. Base demand has been there, renewable demand will be there, EV demand will be there, so that's been there. So every additional ton actually which is taking away from the inventories has to come at a cost. So the cost of getting down those inventories is what the incremental or marginal cost of supply. I think that's where actually the base demand is not going to go away. Whatever the replacement which is possible in renewable energy side has been done. We've been looking at most of these industries where silver can be replaced with any other metal. So I think that's where that's been done. So there is no more further replacements possible. So that actually keeps that base demand. And the inventories have been shrinking quite a bit. And at current levels, every ton which is coming out of that should be justified with the price. So that's where the price rally is going to extend. It's not the large incremental demand. I'm not seeing the 20-30% higher demand coming up. So even it's a demand growth is at around 2%, 3%, or even 4%, that every incremental ton which is getting out of these inventories has to be coming at a much higher cost.
Oh, absolutely. And with the way we've seen prices gain up has been very, very strong. What with, Peter, industrial demand, solar panel demand, I mean, that is yet another thing that took the prices much, much higher. And this is a fifth year of deficit, which markets believe could continue for the next couple of years until you see new suppliers coming back into the market. And because silver is a byproduct, with expectation that copper and zinc perhaps could lead to higher supplies, silver could follow suit. How are you reading the supply and then the industrial demand scenario?
I think industrial demand will be very, very strong, Manisha, and that'll only create more need and want for the silver market. When you're thinking about technologies and how it interfaces into the solar industry, into all forms of computers and technology, and from an electricity standpoint as well, as far as conduction or conducting. So it's just, this is a very sweet spot. And when you get sweet spots in the commodity super cycle, then one needs to really inhale it and just say, I agree with my fellow speaker, 72 probably is where it'll end up or be over this 2026 year. And it might even shoot to the upside quicker than what we expect, Manisha, because this is a hyper bull market. These are very unusual times. We haven't seen this since 79. So I think that that's really the cause and effect. As far as the other industrial metals, yeah, zinc and aluminium still around that 2,800 to 3,000 sort of level. And I think that they'll probably have a little bit of uptick as well. I noticed copper's approaching 11,000 on the LME. So the overall theme, I think, for the industrial metals will be stronger over the first and second quarter. And it's a place to be across also precious metals.
Kishore, you did speak about the international markets therein for silver, but what is it really going to mean for Indian markets in sense of prices going forward?
Indian market, again, when we look at rupee depreciation also take into consideration. So we are looking at around 91.5 as an average price for dollar exchange rate. So that will add a little bit of oomph to the market. I think 2.5 lakhs is what the price which we are looking at, 2 lakh 50,000, 2,60,000. So right now we are close to around 1,60,000, 1,65,000 on the Indian markets. So even at a 50% incremental raise from here, so that will take you to roughly around 2,20,000 to 2,25,000. The base case scenario is 2 lakh plus. An extended case scenario would be around 2 lakh 20,000, 2 lakh 25,000. That's the upside. Again, looking at 18 months, that's what we look at.
Peter, what is your sense on gold then? Because while, of course, silver may outperform and continue to be very, very and more volatile perhaps within the precious metal as a pack, but gold prices, we're not too far away from the all-time highs onto this one as well. And we've seen a good amount of gains come in for this one as well. All-time highs therein, the best yearly gain since 1979. How are we looking at a range playing for next year?
Well, first off, I think I want to say by the end of next month, Manisha, when we're at the tail end of November, I think we'll be at probably 4,500. If we see a rate cut and we're saying it's going to be about an 85% probability, that'll put a rocket under gold and it'll take silver up as well. So the overall theme, that's why I'm thinking, silver's got the capacity. I'll go out there and say, high 50s by the end of December, and gold 45, 45, 50. You'll take an all-time high out. That's my overall theme and what I'm thinking. Rolling into 26, let's keep an eye on 5,000 and how quickly and the acceleration to get to that point. And I don't think it's going to be exhausted at 5,000. I think there's going to be still more momentum in it. So maybe it's going to be a 5-5 over the calendar year of 26. Anything's possible, as it says on the screen. Up 60% in the first 11 months. That's extraordinary.
It has been, and it continues to be, perhaps. So the last 18 months have given us very, very strong returns when it comes to gold and silver. And the next 18 months, pretty promising, as our experts tell us, can be expected for gold and silver both. But with that, we'll go for a short break. Gentlemen, stay on with us, because when we come back, we'll talk about the energy markets. This is a third straight year where we've seen decline come in for crude oil prices. What is it that the scenario can play out in the international markets when it comes to energy is what we'll discuss after this break. Welcome back, and let's talk about the energy markets now, where we have seen the crude oil prices continue to decline for a third straight year. It's down by 18% this year, and we've seen certain pressure come in for heating oil, natural gas and gasoline prices as well. Going forward, of course, is the winter demand season, and there could be some support, but on a yearly basis, we seem to be on a negative side here. Peter, how are you looking at crude? The street, of course, will look out for the OPEC Plus meeting that's on this Sunday. But having said that, it's been a surplus year, with the next year also promising going the same way.
Absolutely, Manisha. So, that structural weakness, the storyline was, 6 months ago, we were all talking about a glut. We were saying there's going to be, and this is going to materialize in the second half of the fourth quarter. Here we are right now. And the storyline, I think, is going to be one of softness leading into the first two quarters of 26. WTI, I'm thinking, is going to be a $54, $55 trade. And let's think about this. If there is momentum moving forward, and there seems to be the general consensus that you might see the Russia-Ukraine situation come to an end sometime in that first half of 26, I think they'll strip out a few dollars as far as war premium or geopolitical. And if geopolitics, and that's a hard one, was to stay static and there wasn't to be any surprises, then that's going to be, I think, another point in time that crude is just going to keep on going lower, and it's a time to be short. It's been a great trade over the last couple of months to be short, and I think that's going to continue.
What's your initial comments on this one, Kishore? Or are you also anticipating a sub-60 kind of level in the first half of next year?
Yeah, of course, I think 58.5 could be possible. And again, see, the demand side fundamentals have not been driving crude for quite some time. And most of the strategic reserves have been filled, so that incremental demand getting into inventories also is not present. So the only thing is which is keeping up the oil prices is that OPEC withdrawing some of these supplies. So even in Sunday's coming up meeting, it's expected that I don't think they will be able to change anything from here, and any more further cuts could be announced. So unless that is done, so there's no real driver for this. And in a free float, actually, despite the Russian oil being taken off to some extent, but still markets will be under pressure, and probably around $58.5, $58 for WTI is potential for the downside.
How are you also looking at, Peter, the demand going forward? Because China is one where we have seen the demand continue to decline. India has been stable, and India seems to be looking at various other markets as well in sense of sources. And then it is about the US production, almost at an all-time high. Are we looking at a perennial problem of oversupply ahead?
Yes, I think we are, Manisha, and absolutely. And I think that's going to be the storyline. Naturally, President Trump wants to increase from his current number, and I think they're going to be quite significant increases, you know, 1 million or 2 million barrels a day coming out of US as far as that drill, baby, drill mantra. I listened to Chris Wright, the energy treasurer, pardon me, Secretary of Energy. They all want more crude. There is no backstep on this. There is no, second guessing. The storyline is going to be, and this administration seems to deliver. When they say things, I listen to Howard Lutnick or Scott Bessent, they deliver. And I'm sure that the Energy Secretary has got the same profile. And that's where it's all about. This first half is going to be one, I think, of increasing supply in the US and how that rolls across naturally the fabric of price. And let's just, strap yourself in, because I think it's going to be softer over 26, which is great for consumers.
Kishore, also comment on the fact that we've been talking about on how great the demand for metals is going to be going forward because of renewables and green energy, etc. And then on the other side, we're also talking about on how fossil fuel demand is not going to peak anytime soon. So whether it is about crude and coal, which continue to be cheaper, easily available, and clearly more in use.
Yeah, of course. I think the entire policy on the global warming and keeping fossil fuels on the lower end and cutting down has now taken a turn after Trump administration taken charge. But again, the markets, when they are stressed, they actually look out for the cheaper alternatives. And as you mentioned, coal remain the cheapest fuel, and especially some of the countries where the developing economies, the cost of energy becomes extremely important when they are under stress. So looking at current levels, I think we are no more in that situation that we'll be ending the fossil fuels anytime soon. But definitely, I think the emphasis on green technologies has been significantly higher than what we have, and it's an all-time high, and that emphasis is going to continue. So I don't think the push on the renewables will come at the cost of fossil fuels, but I think both will expand. And there is, of course, the markets remunerate the renewables much better, and the capital actually is still backing up the renewables and the green energy. So I think that's going to be the future.
And that brings us to the last segment of our discussion, which is about base metal prices, where we also are looking at stronger moves for this current year with the expectation that the next year perhaps could see a spillover of the kind of euphoria that we've seen in case of metals. Kishore, how are you looking at base metals as a sector? We are ending with very strong gains for tin and copper for sure. Zinc has been volatile, and so has been the case for aluminum this year.
So our top picks for 26 will be copper and zinc. Of course, zinc led by the inventory drawdown, and also copper. Also, we're looking at around 12,000 metric tons of inventories. It's like nothing for that matter. And so overall, the demand side is still strong. Overall expansion is happening. So. The grid upgradations and overall renewables and EVs will continue to drive copper. Zinc again. So these two metals are going to outperform. We are looking at around 30-35% rally in copper prices and around 40-45% in a best case, maybe 50% rally in zinc prices.
How would you also look at aluminum, Kishore? Because that's yet another one which has seen strong gains. And we've seen various reports throughout this year on how we've seen supply guidance go down and the mining issues as well.
Yeah, but I think aluminum is, of course, a contender, but I think the relative performance might not be that higher. So we are looking at around 17-18% higher from here, but not a significantly higher move in aluminum.
All right. So if it's going to be 40-50% gain in zinc, around 30-35% of jump up in copper, and 17-18% of gains is what aluminum perhaps could give us in 2026. Peter, how are you putting your metal rankings for the rest of this year and then, of course, 2026?
Well, Manisha, that's their big numbers, and I'm not here to argue with my fellow speaker because I think that I want to see copper get through 12,000, 12,250 to really, and with conviction. And naturally, that zinc number 34, 3,500, that gives me a lot of courage. Courage is what it's all about. And that, from a trading perspective, you've got tin also now at 38,000. It's had a nice run up. Aluminium's, yeah, it's still doing okay. I mean, there it is at 3-year high, but I want to see it, that 3250 to 3400. So I think the overall first is let's get through the first quarter and second quarter to see if that momentum and the trajectory is really strong and bullish and nothing derails it. And then we'll look at, having, better forecasts leading into the second half of 26. But I think it's going to be an exciting time across base metals, industrial metals in the first half of 26, Manisha.
Peter, we do understand that renewables and green energy, and of course the mine issues are some of the factors that would perhaps continue to support the metals. But what about the Chinese demand really? Because that stimulus measures China kept talking about throughout the year but never really rolled out. Is it going to be something of an uncertainty?
Well, they've got their hands full, Manisha. We all understand with, property overhang and the issues you're facing across the real estate sector. And that really calls on much concern to investment, both foreign and domestic. So there's the first half. Secondly, what China's prepared to do. They really have to, grab the bull by the horns, so to speak, to make China great again. And to do that, they've got issues. They've got tariff situation with the US. They've got export hub, how they're going to keep that export engine going. And their demand picture, Manisha, needs to be very, very focused on internal demand. And that's going to be going to be an issue for them. We understand as far as, tariffs, and that could be, a little bit of derailing from that domestic side as far as export. So I think it's going to be a very fascinating first quarter for 2026 for the China-US story.
All right, gentlemen, thank you so much for joining in, Kishore and Peter, and for that very, very exciting, interesting conversation as well. So while we are bearish on the energy markets there, but bullish, absolutely bullish when it comes to silver and many of these base metal prices also as we step into 2026. Well, with that, that's all the time that we have on this show. Thank you so much for joining in.